Let's welcome our market master for the morning, Dehn, Head of Research, Ashmore Group. Dehn, good morning. Thank you very much for joining us. Well, since you are a veteran investor, a seasoned investor on India, give us your perspective. What's caused this recent correction that we have seen in the Indian markets? As an FIO who's invested for more than 20 years, what is the worry?
I think there are probably three reasons why this is happening now. One is that we've had a very strong run in the market, so the market is ripe for some profit taking. But there are also two other important factors, I think, that at the margin will have had an adverse effect on foreign investors' interest in the Indian market. One is, of course, that oil prices have bottomed out and over the last couple of weeks have become more buoyant and moved up above 60. And this means that one of the, or several very, very large currency trades that were put on over the last sort of six to 8 months, namely going long currencies such as the Indian rupee and the Turkish lira versus oil currencies such as the Russian ruble, have run their course and are now being unwound. And I think that's at the margin will make foreign investors a little bit less willing to keep their money in India because they're now taking losses on the currency. The second factor that has created a bit of a sour note, if you wish, for foreign investors is the ongoing uncertainty arising over tax issues for foreign portfolio managers, fund managers operating in the Indian space. The uncertainty surrounding the retroactive taxation of returns in these funds. I don't really have a bone to pick with the Indian government over its taxation, but one thing that is clear is that there has been, in retrospect, clearly considerable amount of uncertainty about exactly what the tax regime is, and that uncertainty is a real negative for investors. Investors don't mind paying taxes, but they want to know what they're going to be paid and when they're going to be charged for it. So I think the government needs to clear up this mess on taxation as quickly as possible, and if it does so, we will look back on this moment without too much concern, because it doesn't really detract very much from the broader outlook for India, which remains quite positive.
Has Ashmore received any tax notices from the government lately?
I don't really want to comment on any of that because I don't know, and it's not me who handles those issues within our firm, so I have no comment on that at all.
All right. Dehn, FIs that enter India through a tax treaty country like Singapore, Mauritius, we understand have not been received any draft notices. What would you like to hear from the government actually? You said you want clarification. What do you want to hear?
I don't think a clarification of the tax regime would in any way deter long-term investors. In fact, I think a clarification of the tax regime would encourage foreign investors. The situation we have now, whether it is money that's coming in directly or through so-called treaty countries, the situation remains that there's considerable uncertainty exactly of what the tax status is, particularly retrospectively. And that uncertainty has to be cleared up once and for all, and as quickly as possible, because otherwise the risk is that this becomes a much bigger problem. It starts affecting the perception that investors have about India, about the perception that India is open for business, and it becomes a much larger domestic political issue as well, and then it becomes so much more difficult to resolve and ends up having economic ramifications that are not only disadvantageous but also ultimately completely unnecessary. So what we need now is leadership, clarity, and then we need to move on.
Okay, so for now, due to this lack of clarity on the taxation front, have you changed your view on India at all? Maybe pulled out some money in the recent past, or are you still bullish for the long term?
No, I haven't. I am, as you correctly point out, I've been following India for a long time. I remain bullish on the Indian story. I think there are a lot of technicals going through the market right now, but I think the Indian story is going to be with us for some time. I think maybe valuations have gotten a little bit tight, technicals a little bit excessive, but these are very short-term considerations. I think ultimately, I believe strongly that India is still on the right path and that there is more reward for those who want to be invested there. My only regret is that the government is moving so excruciatingly slowly in terms of opening its markets to fixed income investors. It's bizarre that there is free access for anyone who wants to trade the currency or to trade into equity markets, de facto free access. But bond markets, which tend to attract much more long-term institutional flows that tend to be far more stable than equity markets, are still in effect barred from access. And particularly at a time such as now, when there are some questions raised over the situation, particularly in the equity markets, you can see that equity markets can be very volatile. Bond markets bond markets would be a very nice buffer at this point, would be attracting flows even as foreigners pull out of the equity markets. So I think my only frustration is not about my doubt is not whether I want to invest more in India. My frustration is that I can't invest any more than I already have on account of the quotas that apply to fixed income markets.
Okay, just in the near term, do you expect to see more downside for equities? I mean, like I told you, we are already 8% down from the recent highs.
Yeah, I think we still have some question marks hanging over the Indian market, both technicals, the tax issue, and the currency. The currency angle I alluded to before, with the recent adjustment that we've seen in oil prices. I think these external factors will have to play themselves out, and I think there is still some adjustment to be done in the market on the back of that. I think the story though remains intact. We are likely to see, particularly in the second half of this year, a greater pickup in the economy. We're probably also going to see further easing from the RBI, and I think that's going to start driving earnings higher towards the second half of this year. Earnings have been somewhat more lackluster than had been anticipated. We haven't really seen as strong a domestic pickup in the economy as had been expected, and this has weighed on earnings. But part of that is to do with weather-related effects and droughts and so on. But some of it also has to do with a very slow pace of investment by corporates in India. However, I think the upside is still ahead of us. It just means that the earnings pickup comes a little bit later than what had been expected. So I think the markets do have a little bit more adjustment to go through at this point.
Okay, so just to compare the India versus China story then, before we let you go, Jan, where are you deploying incremental money between India and China?
I think there's a technical trade in China which has barely begun. The Chinese have, rightly in my opinion, recognized that the current global macroeconomic conditions are nowhere near equilibrium, and when growth starts picking up, inflation will pick up, and then it'll be very difficult for Western central banks to raise rates materially because there's simply too much debt in their economies. And that does suggest that over the next couple of years we are going to see a return of inflation. For China, that is a major threat. With the largest reserves in the world, the Chinese renminbi is likely to be the strongest performing currency in the world over the next decade. That will make it very difficult for Chinese economy to export. And so the Chinese have recognized this and are in the process of making a wholesale adjustment towards domestic demand-led growth. As they increase domestic consumption in China, they will be importing more. And in order to finance these imports in the balance of payments, they're liberalizing their capital account, that is, opening their domestic markets to foreign investors, both in terms of equities and in terms of access to fixed income. And when you then take into account that between them, the domestic equity and fixed income markets in China are close to $10 trillion in size, this is just a formidable number. And when you take into account that foreign investors have practically no exposure to these onshore markets, we are really looking at an enormous technical, which has not even begun to be priced into the Chinese market. I think this is going to be extremely supportive for the domestic markets in China, and I think as China's currency becomes a global reserve currency by possibly as early as late this year, in December of this year, when the IMF has its meeting to decide whether to include the renminbi or not, China is really moving into a completely different gear and will then once again leapfrog ahead of India. That doesn't mean that there are no interesting opportunities in India, but India is still really trading its own domestic recovery trade from the last administration, the internal reforms that are going on, the cyclical upswing, the slowdown in inflation, and so on. This is a cyclical story in India. China's story, on the other hand, is a structural reform story, and as such, it is a much, much bigger opportunity than what is currently on offer in India.
All right, we'll leave it at that, and then out of time. Thank you very much for that comprehensive analysis of the Chinese markets and their possible structural break. Of course, there are several views on this.